we revisited what we did in 2016 and we thought, well, let's look at a growth stock that we think is an amazing company, and then we can use that as our benchmark growth stock. And we said, let's look at Google. Google, we think, has got one of the best business models in the world. We looked at its PE. It's trading on 17 times June 2017 and about 15 times June 2018 once you strip out the 110 billion of cash that it's got. It's got about 17% EPS growth. We then lined up a whole bunch of stocks in the Australian market: Iris, Carsales, Real Estate, Domino's, and we looked at how large their PEs are relative to Google, and how much EPS growth they had, and it just stood out that there's still a massive gap between what Australian growth investors are prepared to pay for compared to what American growth investors are paying for Google. And in some cases, Iris and Carsales had forecast EPS growth 30% less over the next 3 years than Google, and yet we're trading on a 30% premium relative, PE premium relative to Google. So we just went, well, there's some warning signs still here in this market that some of those market darlings are not going to be able to perform in 2017. The reason Australian growth stocks are trading at such high prices, twofold. It's a weight of money. That's been a crowded trade. There's a lot of money in the Australian superannuation sector that has been allocated to domestic equities. And now you're seeing an increasing valve where people are needing to release that into international markets. And so we're seeing companies like Magellan and other international fund managers sort of building businesses on that very issue that you have identified, that there's just too much money chasing too much of a good thing in Australia. We've looked at some of the out of favour stocks. Southern Cross Media has been a good performer for us this year. We still think that it's going into an earnings upgrade cycle. It trades on about 11-12 times PE with a reasonable balance sheet and a good dividend coming into this first half result. We're quite confident that this stock will deliver. But you know, it's got a mix of radio and it's got a mix of TV, and it's a little bit out of favour. So that's the style of stocks that we've had to kick the tables on and really dig down. Green Cross is another interesting stock that we'd been accumulating around the low sixes. It had some issues with like-for-like store growth, but we noticed last night Mars is bidding for Woof, which is and paid 15 times EV to EBITDA for the Woof business, which runs veterinary services and clinics in the US, which implies quite a high underlying value for a business like Green Cross. So it's been a combination of kicking the tyres on some out of favour stocks, of finding some beaten up growth stocks. We are style neutral, but it's still not easy. We I'd say at this point we haven't seen any large opportunity set emerging for, I guess, what you call no-brainer trades. They're all really hard work and require a lot of analysis to build the confidence to take the positions.